When most investors look at the price of silver, they assume it moves because of inflation headlines, geopolitical tension, or retail demand. But silver is not priced in coin shops. It's not set by jewelry stores, and it's not determined by small investors buying physical bars. Silver price is discovered primarily in the futures market, specifically through highly liquid contracts traded on major derivatives exchanges. To understand silver, you have to understand price discovery. When you check the spot price of silver, you're looking at a reference price. That reference is largely derived from futures contracts, standardized agreements to buy or sell silver at a future date and predetermined price. These contracts trade continuously during market hours. They attract significant institutional participation and deep liquidity. Because of that liquidity, the futures market becomes the dominant venue for price discovery. In simple terms, the futures market leads, the spot market follows. So who participates in this process? There are three primary groups. First, commercial hedgers. These include mining companies and large industrial users of silver. A producer may hedge future output to stabilize revenue. An industrial buyer may hedge to manage input costs. Their objective is risk management, not speculation. Second, institutional participants. This includes hedge funds, asset managers, proprietary trading desks, and banks. These participants allocate capital based on macroeconomic data, interest rate expectations, currency strength, and broader portfolio positioning. Their decisions are often systematic, model-driven, and forward-looking. Third, speculative traders. These market participants aim to profit from short to medium-term price movement. They provide additional liquidity, but they operate within the same futures structure. Retail participation exists, but it represents a relatively small fraction of total futures volume. That distinction matters, because it means silver pricing is influenced primarily by institutional positioning and commercial hedging activity, not by retail coin demand. Now, this helps explain something many investors find confusing. Why doesn't silver always react immediately to major headlines? Inflation surprises to the upside, yet silver barely moves. Geopolitical tension rises, but price action appears muted. The reason is straightforward. Markets are forward-looking. Institutional participants analyze expectations before headlines become mainstream. Positions are often established based on projected outcomes, not reactive commentary. By the time a news event is widely discussed, positioning in the futures market may already reflect those expectations. In other words, what feels like a delayed reaction is often a reflection of prior positioning. Another key factor is leverage and liquidity. Futures contracts allow participants to gain significant exposure to silver with comparatively small margin requirements. This creates high trading volume and concentrated price discovery within the derivatives market. Physical silver supply and demand absolutely matter over the long term. Industrial demand, mining output, and macroeconomic cycles shape broader trends. But in the short term, price movement is largely driven by capital flows inside the futures market. Understanding this structural dynamic changes how you interpret price action, instead of asking why didn't silver react to this headline. A more precise question is, how was the futures market positioned ahead of this event? That shift from reaction to structure is critical. Silver pricing is not random, is not chaotic, and it is not primarily retail-driven. It is shaped by institutional positioning, commercial hedging activity, liquidity concentration, and forward expectations. Once you understand where price discovery occurs, market behavior becomes far more logical. And in financial markets, structure always matters more than noise. If you value clear structural breakdowns of silver and precious metals markets, this channel focuses on exactly that.